Beneath the surface of headline figures that appear to show inflation cooling, inflation in the United States remains an unfinished and evolving story. It no longer roars as it did during the 2022 peak, yet it has not disappeared. Instead, it behaves more like an underground current, quiet, difficult to detect, but powerful enough to reshape the economic landscape if adverse forces align. For this reason, any serious evaluation of U.S. inflation cannot rely solely on short-term data points. It must examine the deeper structural dynamics at work. At first glance, the macroeconomic picture appears relatively encouraging. Consumer price inflation has fallen substantially from its peak above 9% in 2022 and now hovers below 3%. Recent quarters have delivered solid GDP growth, suggesting that the U.S. economy has so far avoided a clear recession. The labor market, while cooler than during the immediate post-pandemic rebound, remains historically resilient, with unemployment still low by long-term standards. Together, these factors have reinforced the belief that the U.S. may be achieving a soft landing after one of the most aggressive monetary tightening cycles in decades. Yet inflation is not a single uniform phenomenon. Goods inflation, which surged during the pandemic due to supply chain disruptions and extraordinary demand, has eased as logistics normalized and consumer spending rotated away from physical goods. Services inflation, however, tells a different story. Prices for housing, healthcare, education, insurance, dining, and personal services tend to rise slowly but persistently. These sectors are highly labor-intensive, and their costs are closely tied to wages. Once wages increase across the economy, they rarely decline unless a deep recession forces broad job losses. As a result, services inflation tends to remain elevated even after goods prices stabilize. This is why services inflation is often described as sticky. Even as the pace of increase slows, the overall price level for services remains significantly higher than before the pandemic. Bringing inflation sustainably back to the 2% target therefore becomes a much more difficult task, even in the absence of new commodity or supply shocks. Fiscal policy further complicates the picture. The United States continues to operate with large budget deficits and elevated government spending on defense, infrastructure, industrial policy, energy transition, and social programs. In the short term, this spending supports growth and cushions the economy against sharp downturns. Over the longer term, however, persistent fiscal stimulus can keep aggregate demand firm, limiting how quickly inflationary pressures dissipate. When strong public spending coincides with a private sector that has not fully cooled, inflation tends to settle at levels higher than those seen before 2020. Monetary policy is therefore caught in a genuine dilemma. After successive interest rate hikes, policy has reached a zone where additional tightening risks significantly damaging growth, credit conditions, and investment. At the same time, easing policy too early risks reigniting inflation, particularly if services prices remain stubborn. This tension explains why policymakers have adopted a cautious, data-dependent stance rather than offering clear forward guidance. Each decision now carries greater uncertainty than earlier in the cycle. Technology, especially artificial intelligence, introduces another layer of uncertainty. Optimistic narratives portray AI as a productivity revolution that will allow firms to produce more with fewer resources, easing labor costs and inflation pressures. While this outcome is possible, it is not guaranteed. Historically, productivity gains from major technologies arrive unevenly and with long delays. If massive investment in AI takes longer than expected to translate into economy-wide productivity gains, growth may slow while costs, labor, energy, and capital remain elevated. In such a scenario, inflation may decline only gradually, even as economic momentum fades. Geopolitical tensions and changes in global trade structures further reinforce inflation's structural nature. The era of deep globalization that helped suppress costs for decades is giving way to a more fragmented system. Supply chains are being diversified, production is being reshored or friendshored, and geopolitical risks remain elevated. These shifts improve resilience but often raise costs, which are ultimately passed on to consumers. Inflation, in this context, becomes less a temporary shock and more a reflection of higher baseline system costs. Taken together, these forces raise the risk of a particularly challenging environment in which economic growth slows while inflation remains elevated. In such conditions, traditional policy tools lose effectiveness, cutting rates to support growth risks, fueling price pressures, while maintaining tight policy to fight inflation risks, weakening employment and demand. Policymakers are forced to accept trade-offs rather than pursue ideal outcomes on all fronts simultaneously. Financial markets are especially sensitive to this balance. Equity prices have benefited from expectations of eventual rate cuts, but those expectations may be revised if inflation progress stalls. Bond markets, which are highly sensitive to interest rate paths, also face heightened volatility when policy outlooks become uncertain. For households, the challenge is more immediate. Even as inflation slows, prices remain high, and real incomes may struggle to keep pace with the accumulated rise in living costs. Despite these challenges, the United States retains important long-term advantages, including a flexible labor market, deep financial systems, strong innovative capacity, and a currency that anchors the global monetary system. These strengths enhance resilience, but do not guarantee a return to the ultra-low inflation environment of the 2010s. The post-pandemic world is defined by greater supply uncertainty, geopolitical fragmentation, and structural transitions in energy, technology, and demographics. Ultimately, U.S. inflation today is no longer just a story told by monthly statistics. It is a complex interaction of economic structure, fiscal and monetary policy, technological transformation, and global realignment. The risks may not be immediately visible, but they tend to emerge as growth slows and economic buffers thin. Understanding this reality is essential to avoiding complacency and preparing for the volatility that may lie ahead. And you? What do you think about this? Please share your deepest perspective and your thoughts on the near-term outlook. Your insights would be extremely valuable to me and to everyone else.